The Barack Obama presidential coin set is not available in stores, so call 1-800-724-4695 and order now.
Good morning and welcome back to Money for Breakfast. I'm Alexis Glick. Coming up in Money for Breakfast, we're going to talk about refinancing your home. Is now the time, and what are the potential costs? And as the U.S. automakers struggle, foreign automakers are launching new marketing campaigns, and they're getting pretty creative. We'll tell you about that in a moment. But homeowners facing foreclosure may get some help from lawmakers who are proposing the bankruptcy judges eliminate some mortgage debt. This comes as mortgage rates right now are hitting a 37-year low. With more in the state of the housing market and what steps the Obama administration will take to turn it around, I'm joined by Adam Michelson. He's a former senior vice president of marketing at Countrywide and author of Foreclosure of America. Good morning. Good to see you.
Good morning. Thank you for having me.
So mortgage rates are at a 37-year low, and we now know that the Federal Reserve Bank is out there purchasing mortgage-backed paper in hopes that they will continue to lower interest rates. What kind of impact do you think this will have on the ability of people who are either sitting on the sidelines to go out and buy homes or people who are looking to refinance their homes?
Well, clearly lower rates are better for consumers if the opportunity is there for them to refinance. But the reason why I wrote the book, The Foreclosure of America, was to provide the last missing piece of history of the mortgage crisis and to provide the first insider's view of what was going on inside the hallways of Countrywide as the crisis was being born, and answer the question that all of America seems to be still asking: what on earth were these financial companies thinking in offering these loans? What I hope to achieve is to allow every reader of my book to be in the conference rooms with me and judge for themselves what went wrong.
All right, so let's put aside your book for a second, and let's talk about the foreclosure rate in this country right now, which about 3% of properties are either on the cusp of foreclosure. Some say now as many as 7% have been foreclosed upon. The numbers continue to grow and grow and grow. How do we address the foreclosure problem?
Well, as President-elect Obama has said very smartly, is that the only thing we're sure of is that if we don't do anything, it's going to get a lot worse. Policymakers are going to have a lot of work to do in terms of solving this crisis. And not to touch on the book so quickly, but there is a policy proposal in the book that offers up some common sense things about ending adjustable rate mortgages, about deciding who to help first. Those people whose trigger event, their foreclosure trigger event, was perhaps out of their control, people with a good history of financial choices. Perhaps those are the people we help first. And the people that perhaps we help last are those who made poor choices, who have a history of poor choices, who had a trigger event in their control, who went out and bought 5 cars when they had a mortgage that they knew they couldn't pay back. Perhaps those are the people we help last.
So are you convinced, though, that the financial institutions which should take a part in making sure that people remain in their homes are doing their job, or that there are loans to be had out there?
Well, there are always loans to be had out there for the right consumer who makes the right choice for their own budget and their own household. Financial services companies will continue to offer money to those to help who can benefit from it, who have the ability to pay it back, hopefully, from now on. But also, at the end of the day, it's really about helping them achieve a better quality of life through the thoughtful consumption of money. You know, a lot of people have vilified financial services companies in this story, but at the end of the day, money is like food. When consumed in thoughtful, moderate ways, it can benefit your life. When it's overconsumed recklessly, it can be disastrous.
All right, Adam, thank you very much. Good speaking to you, Adam Michelson. Well, with these low mortgage rates, homeowners are faced with a dilemma of whether refinancing their home to save money is the right choice for them. Julia Blake is a homeowner considering refinancing, and Chip Cummings, the president of the mortgage consulting company Northwind Financial Corporation, is here to give us some good advice. Julia, let me start with you, because personal stories are the ones that resonate most with all of us. Tell us about what your current situation is and what you and your husband are considering doing in order to bring down your monthly mortgage payments.
Oh, so I have right now a jumbo loan. It's a decent rate. We bought our house a couple of years ago. We've put a lot of work into it, and our loan-to-value ratio is about 60%. But I am seeing that interest rates for conforming loans are much better than the loan I have, and I'm not very far off from the conforming loan limit. So my idea is to get the conforming loan at a great rate, and then to go ahead and finance the rest of my house debt in a home equity line of credit. Now, we only have house debt, so I would just have those two loans, and we don't have any car loans, no other debt.
Okay,
but
so
it looks like I can save about $300 a month approximately in my monthly payment.
Chip, let me bring you in for a second, because Julia is talking about an issue that's affecting a lot of people across this country. There is a level by which Fannie Mae and Freddie Mac will purchase mortgage paper or issue it. When she talks about that conforming loan level or above that, what are the conforming loan levels, and what does she mean? Because there's a hugely different rate between a jumbo mortgage and a traditional conforming mortgage that would be backed by a Fannie or Freddie.
Well, you're right, Alexis, there is, and that changed just on January 1st, as a matter of fact. What happens is Fannie Mae and Freddie Mac had a limit of $417,000 that they were able to insure or purchase in the marketplace, and they're the largest purchaser of mortgages. And with the President's Economic Stimulus Act, what it did is it increased that to just over $729,000 before you got into what's called a jumbo mortgage. Unfortunately, on January 1st, what happened is the limits changed again, and they came down by about $100,000, which is the situation that Julia finds herself in. And unfortunately, she's not the only one. A lot of people are feeling the pinch right now because those rates are so much higher.
So, Julia, I imagine what you're finding is that you have borrowed more than that $417,000 limit. I understand there's a different limit there in Boston, but that I assume for a jumbo rate mortgage for more than that money, the rates that you've seen are not that good, and that's why you're considering splitting it up into two mortgages. Tell me what you found by doing your homework.
Well, it's interesting. I have not been able to have anyone in Boston tell me that I can get a conforming loan for more than $417. I was looking at this at the end of '08, and I could never find anyone that could give me more than $417. And right now, you know, I actually have a decent rate on my jumbo, but when I see conforming loans that are so much better rate, it's attractive to me, and that's when I want to maybe get creative and maybe get this second loan that I think I could pay off fairly quickly. And my ultimate goal is to be at or below that conforming limit, just to reduce our debt. That's my goal. I'm just not finding anything that's, you know, as attractive as it should be, I think.
Yeah, you know, Chip, I have to say, I went out there and I have a jumbo mortgage situation as well. I found, number one, the jumbo mortgage rates were astronomical. I know in some cases in this country, you can get a conforming loan for 5.25%, but if you go above that $417,000 mark, some of those jumbo rates are as high as 8%. Why the huge disparity when in some cases, like Julia's, she might be talking about an additional $50,000 above the conforming loan? Why would anybody want to pay 2-3% higher?
Well, they wouldn't, and you're right, that's the point, and welcome to the credit crunch, Alexis. What's happened is that the government has agreed that they're going to purchase these mortgage-backed securities from Fannie Mae and Freddie Mac, and by law, they're limited in terms of what they can do. There are some high-cost areas around the country, and Julia's area obviously is not one of them, where they can go a little bit above that 417. But as soon as you go past that limit, what happens is now you have to go to private investors and other institutions such as the old Shearson Lehmans and the Goldman Sachs and the ones that aren't around anymore to purchase those securities, and the money's just not there. And the banks really don't want that risk on their books, and as a result, you're right, you're seeing rates at the 8%. I think it's around, the average is 7.25 right now for jumbos around the country, but I just had a client that did exactly the same thing Julia did. And I haven't seen this in the 27 years I've been in this business, such a disparity, but they're capping their first mortgage at that limit and then taking out a second home equity loan or even loans against their 401k in order to make up the difference to take advantage of those lower rates, because there is such a huge difference out there.
It's an incredible story. Well, Chip and Julia will continue to follow it. And Julia, keep us up to date on how you're doing in refinancing, because I know the costs are so expensive as well. Thank you guys so much.
Thank you very much.
Thanks,
All right,
Alexis.
coming up, the latest on the Israeli ground assault in